Assalamualaikum warahmatullahi wabarakatuh.
Welcome to Emirates Corporation.
Assalamualaikum. Meeting time.
Waalaikumsalam, bos.
Waalaikumsalam.
Kami bos, bos.
Oke, bos.
Assalamualaikum.
Waalaikumsalam.
You look very stressful. If I may ask, what's bothering your mind?
My investment performance is not as per what I expecting. But inshallah, there will be a solution from this meeting.
Amin, amin. Inshallah, brother.
Assalamualaikum ya.
Waalaikumsalam, Mbak Frida.
You look so happy today.
Well, of course.
Why?
Well, my performance is good last week, and I'm sure the CEO will be happy for hear it.
Alhamdulillah. I'm so glad to hear about it.
Thank you.
Good morning, team. Assalamualaikum warahmatullahi wabarakatuh. Let's start our weekly meeting today. I hope to hear good news. Market index was improved last week. By the way, did you read the book that I gave you?
Which book, bos?
The Warren Buffett Way.
Oh yes, bos.
Okay. Let me hear your report. Start with Danny.
My portfolio performance for the last 3 months is quite stable, boss. Although it is not going too well for the last couple of weeks, it's minus 10%. But if we look on 1 year base, it is actually averagely stable and it's still growing, boss.
Seems not so promising. Can you find explanation from Warren Buffett Way?
Yes, boss. If I look on Warren Buffett principle, from the business standard perspective, there are several things that must be considered. First, business is simple and understandable. Second, it has consistent operating history. And third, it has a good long-term prospect. Now, from my portfolio profile, we can say that it has consistent operating history, boss, and a well-established company in Indonesia with over 100 years history. It has continued to deliver strong performance. It recorded double-digit growth year-on-year in revenue and also net income. However, boss, it is true that this company has a complex business considering the digital transformation that this company faced.
Thank you, Danny. Now it's your turn, Kiki. Please.
Nauzubillah min zalik, boss. My investment is declining 8% since I bought it from the last 3 weeks. Even though the sector is growing, and the stock is actually grow by 24% from the beginning of the year. But inshallah, I believe it's only a short-term effect. In the long run, it will gain back to positive trend.
Your performance very worse, Kiki. Can you explain from Warren Buffett Way?
Based on Buffett approach in evaluating a business or stock, I should review my portfolio from the management tenet first. Management is based on rational principles, including investing excess capitals at above average rate of return to shareholders. Managers should be honest with the shareholders about the company.
Thank you, Kiki. I hope we'll have a good news from Frida and Mia. Frida, please.
Well, my portfolio last week, Alhamdulillah, boss. Last week is very good, which is increasing at 2.25%. So this is very good news for me. Also, the chemical sector on my portfolio is continuing into positive in the market. They're also gaining net profit into 3.38 trillion according to the financial record.
Frida, it sounds not so good but not so bad. Again, if you read from Warren Buffett Way, what can you explain?
Well, boss, according to the Warren Buffett books, he said the most important things that we cannot go to bed thinking every night about the price of the stock. We think about the value and company result. That's the most important thing. And also the stock market is there to serve you, not to instruct you. So we just follow into the market. And also he put something in the book, great investment opportunities come around when excellent companies are surrounded by unusual circumstances that cause the stock to be misappraised. And then he put something about his way on the book. He said, to properly value a business, you should ideally take all the flow of money that will be distributed between now and Judgment Day and discount them at an appropriate discount rate. That's what valuing business is all about. Part of the equation is how confident you can be about those cash flow occurring. Some businesses are easier to predict than others. We try to look at business that are predictable. That is the conclusion about the Warren Buffett way into the market tenants.
Thank you, Frida. Next, Mia. I hope I will hear good news from you.
Well, Alhamdulillah, boss. This week, my portfolio in mining sector have a good performance. It's gained 3% compared last week. The price of coal touched $90 per metric tons. It is 20% higher than 2016. This helped the performance of my portfolio, which already booked 5 trillion rupiahs for our income.
Thank you, Mia. That is true a good report for me. So, I hope you can explain to your friend how you learn from Warren Buffett and you implement that in your business.
Based on Warren Buffett financial tenet, he said that we need to look the company return on equity rather than the earning per share. Select a company with the high profit margin. Seek a company that create at least $1 of market value for every dollar retained.
Thank you all for your all-present report. I hope we'll do better next week. Assalamualaikum warahmatullahi wabarakatuh.
Hello everyone. I am Kathy, the Emirates Group personal assistant. Investment strategies of the world's greatest investor, Warren Buffett. He is one of the most successful stock market investors of the past 30 years. His entire approach is to focus on the value of the business and its market price. Once Buffett finds a business he understands and feels comfortable with, he acts like a business owner rather than a stock market speculator. He studies everything possible about the business, becomes an expert in that field and works with the management rather than against them. Buffett maintains a long-term perspective at all times, and never loses sight of the underlying value of a business.
I'll have a sausage McMuffin with egg and cheese. $3.17 is a bacon, egg, and cheese biscuit. The market's down this morning, so I think I'll pass up the $3.17 and go with the $2.95.
Warren Buffett is the only person who, from scratch, built a company that is in the top 10 of the Fortune 500.
I was always playing around with numbers. I find it enjoyable. There were 2 turning points in my life. Once when I came out of the womb and once when I met Susie.
Warren is smarter than you even know. I think sometimes geniuses are by default lonely and isolated.
I was a lopsided person. She put me together. I thought I would pile her money, then she would unpile it, running a foundation, and therefore society would benefit. 99% of everything I make will go to others.
The largest gift ever given. It was completely amazing.
Investment problems, they're easy.
The author of the Warren Buffett Way book is Robert G. Hagstrom, the Senior Vice President and Director of Legg Mason Focus Capital and Portfolio Manager of the Legg Mason Focus Trust. He previously wrote the Warren Buffett Portfolio, Mastering the Power of the Focus Investment Strategy and the NASCAR Way, the business that drives the sport. Warren Buffett was fascinated by numbers. By the time he entered kindergarten he has become a counting machine. His childhood days were in extreme poverty. By the age of 6 he has started doing business. His first business was of selling chiclets. He kept on growing his business. He would buy a 6-pack of Coke at his grandfather's grocery store for 25 cents and sell the individual bottles for 30 cents. He also sold the copies of newspapers and magazines door to door. By the age of 9 he has started developing interest for stocks. He was the frequent visitor to his dad's brokerage office. He started reading books on investment from his father's bookshelf. When Buffett turned 10, his stockbroker father asked him what birthday gift you want. He said, "I want to see New York Stock Exchange, take me there." By the age of 11 he began charting stock prices himself. His first investment was at the age of 11. He bought 3 shares of City Services. Sold it for a profit of $5. But the stock went up 100% in few months. Buffett learned the first lesson that stocks should be held for long. The Warren Buffett way. An investor should only buy shares in a company which he would be willing to purchase outright if he had sufficient capital. From this perspective, an investor should look for a company with business operations that are understood, has favorable long-term prospects, is operated by honest and competent people, and is available at an attractive price. The decision to buy a business is based on business tenets, management tenets, financial tenets, and market tenets. There are 3 business tenets from the Warren Buffett's way. First, simple and understandable for investor. Is the business simple and understandable from the perspective of the investor? Do you understand how the company generates sales, incurs expenses, and produces profits? That means you need to understand revenues, expenses, cash flow, labor relations, pricing, flexibility and capital requirements, an exceptionally high level of knowledge. It means that investors should buy shares only in companies within their own circle of financial and intellectual understanding. An investor need to be realistic about what they do not know. Above average results are most often achieved by doing ordinary things exceptionally well. Business tenet number 2. Consistent of operating history. Does the business have a consistent operating history? In general, the best level of profits over the long term are achieved by companies that have been producing the same product or service for a number of years. One-off windfalls generated by unusual events are just too hard to reasonably predict. An investor should never ignore a current business reality because of some vision of future success. Look to buy a business which has shown it can reasonably weather different economic cycles and competitive forces. The best time to buy any business is when profitability has been interrupted for some external short-term reason. This can create a rare one-time opportunity to purchase a sound business at an unusually low price. Business tenet number 3. Business have favorable long-term prospect. The economic world is divided into a large group of commodity companies and a small group of companies that own the franchise for their product or service. Commodity companies compete solely on price, with no differentiation between suppliers. As well as the traditional oil and gas companies, the commodities group now includes computers, automobiles, and airlines. By contrast, companies which own the franchise have a product or service which is needed, has no close substitutes, and for which an unregulated market exists. Ideally, a business purchaser will want to buy a franchise type of company. These companies have an appreciable margin of safety whereby prices can be raised to offset management mistakes. The only problem is a strong franchise holder soon attracts competitors and substitute products, which in turn leads to the creation of a commodity market around that product or service. Whenever that happens, the value of the management becomes even more critical to the economic performance of the company. If it is not possible to purchase a franchise company, the next best option is to buy the lowest cost supplier in a commodity market. Over the long term, the lowest cost supplier always comes to dominate a commodity market. There are 3 points of management tenets. First, is management rational? Does the management act and think like an owner of the company unfailingly? In particular, how is capital allocated by the company? Rational managers will invest any excess cash generated by the company in projects that produce earnings at rates higher than the cost of capital. Over the long term, allocation of capital determines the value of the company. All companies move through an economic life cycle. In the development stage, the company loses money while establishing markets and improving its products. During the next stage of rapid growth, the company requires cash to grow and retains earnings and borrows or issues more equity. In the third stage, maturity, the company generates more cash than it needs as sales expand. In the last stage, excess cash tapers off as sales decline. The key question is what managers do with the excess cash in the maturity and decline stages. A rational management will invest this cash in projects that earn a higher rate of return than the cost of capital on the open market, otherwise the funds should be returned to shareholders as dividends or by buying back the company's own shares. By contrast, irrational managers are often overcome by their own prowess and continue to reinvest in projects with diminishing returns. Second, is management candid with its shareholders? The ideal business manager reports financial performance openly and genuinely, with an ability to admit mistakes and report the progress of all aspects of the company. The management should also be able to reaffirm that the company's prime objective is to maximize the return on shareholders' investment. This concept should color every action taken. The tendency to include every piece of information that owners would deem valuable when judging the company's economic performance is a characteristic of a strong management team. Third, does management resist the institutional imperative? The institutional imperative is the tendency of corporate managers to mimic the actions of other companies, even when those actions are destructive or irrational. Most managers are so influenced by what other companies are doing that they are unwilling to do anything which results in short-term pain in exchange for long-term profit. A measure of any company's management skill is how effectively they think for themselves rather than settle for mindless imitation of what everyone else is doing. In essence, successful companies have managers who refuse to follow the herd into mediocrity. There are two market tenets. First, what is the value of the business? Buffett calculates the value of a business as the net cash flows expected to occur over the life of the business discounted at an appropriate interest rate. Net cash flows are the company's owner earnings over a long period. Something like the 30-year U.S. Treasury bond rate can be used as a measure of the interest rate for this calculation. By calculating the business value this way, vastly different business enterprises can realistically be compared. If the business is growing rapidly but has unpredictable future revenues, then the company is not classified as simple and understandable, and this formula cannot be applied. The discounted cash flow approach described is very conservative as long as an appropriate discount rate is applied. Second, can the business currently be purchased at a significant discount to its value? Armed with an accurate calculation of the value of the business, you should now look at the asking price. The rule for market success is purchase only when the current market price is at a significant discount to value. The intention of any investor is to earn above average returns. The difference between business value and price is the investor's margin of safety. Most investors set their own margin of safety. Buffett generally aims for a 25% discount as his margin of safety. Additionally, a well-chosen stock will have sound fundamentals, which over the longer term will lead to an above-average growth in the company's share price. This, in effect, becomes an additional reward for the intelligent investor who purchases at a discount.
Okay guys, I've seen all your performance report. All looks very good. It seems all of you have learned from Warren Buffett way. Can you tell me learning lesson from Warren Buffett? Start with you, Danny.
Lesson learned number 3 is, we have to remember that we are not buying a stock, we are buying a business.
Good, Danny. Kiki.
Lesson learned number 4. Select the business available when you manage your portfolio. You don't have to widely diversify, and you don't need to include every major industry. Stick to the business you know best, businesses that do well and provide good value.
Good, Kiki. Frida.
Well, boss, according to the Warren Buffett book, lesson learned number 2 is forget what happened to the economy. Don't worry about economic cycle.
Good, Frida. Mia, last one.
Well, boss, first lesson from Buffett, he said that we need to forget what happened on the stock market. Don't pay attention to it. Start focus on our company performance.
There are 4 key steps of Warren Buffett way. First, forget what happens on the stock market. Don't pay attention to it. Second, forget what happens to the company, don't worry about economy cycles. Third, remember that you are not buying a stock, you are buying a business. Fourth, select the best businesses available when you manage your portfolio. You don't have to widely diversify and you don't need to include every major industry. Stick to the businesses you know best, businesses that do well and provide good value.